Hello, everybody. I'm very excited to be here on Hopping. So my name is Kieran. As Esme just said, I'm a partner at Ascension. We are a UK-focused VC and have been going for about 6 years now and focused on that first and second check, so pre-seed and seed stage. With about 130, well, 140 portfolio companies now. So we're a high-volume investor, as are two of my guests coming on today. So we've got a lot to say on fast investment checks. Some of my first investment checks include said Hopin, also WageStream, Lick, Vine Health, Hago, which a lot of the UK ecosystem will know about, and hopefully the US will do soon too. And as Esme also mentioned, I founded something called the Debut Sessions last year with a bunch of other VCs in the UK, including Harry Stebbings, Carmen Rico, Czech Warner, and some others. The idea is to connect content, community, and capital together. It consists of a live pitch competition in which the winner receives a £100,000 investment from Ascension within 72 hours of the competition finishing. And then we build a bunch of content on top of that, masterclasses on how to build your deck or how to look at a term sheet, and then panel sessions with some high profile people in the founder and investor ecosystem. So pre-seed and fast investment checks are something I get very excited about, as I am equally excited to bring Elizabeth and Andrea onto the stage as well. Welcome.
Hi there.
So maybe I'll get I'll get Andrea to introduce herself first. So Andrea, do you want to introduce yourself in Basecamp Fund, and then Elizabeth, do you want to follow that, and then we'll go straight into questions.
Sure. So where to start? Basecamp is a San Francisco and New York based fund. We're part of a larger fund of funds called Alumni Ventures, but Basecamp specifically focuses on pre-seed and seed. Our check sizes are anywhere from 100K to 250K. We can dial that up and down as needed. And the areas that I myself like to focus on lean more B2B and fintech, but we look at everything. And I run the fund with my partner, Matt Scott, who's based in New York. So yeah, that's a little bit about us.
And yourself, Elizabeth?
Hi, everyone. I'm Elizabeth Yin, and I'm a general partner at a firm called Hustle Fund. We are also a pre-seed fund, and we also write a lot of checks, like my fellow colleagues here. We invest 25K. We can make a decision after speaking with a founder, usually within 48 hours. And we invest fairly globally these days in a variety of different sectors in software. Even within B2B, kind of like what Andrea is talking about, there are many different verticals, construction, agriculture, et cetera. We pretty much span the gamut on a lot of different industries.
Very cool. So I'm going to split this session, I think, into two parts. One is a kind of macro view as an investor around the pre-seed landscape, nothing too difficult, hopefully, and then dig a little bit more into founder-related stuff. So before going into that, actually, you're both unique in this world, I guess, in that you've been operators, you've been angels, you've worked at funds, and now you're GPs and run your own fund. So, like, maybe I'll start with you, Andrea. Just the kind of, why did you get into the pre-seed world? Like, why move from operator to investor, and kind of what's that experience been like?
I think my answer is going to be rather cheesy because I can't imagine that it's uncommon to hear, but I went to the dark side, the venture side, after running my startup and then ultimately closing it down because I wanted to be the kind of investor that I wished that I had had. Not to say that our investors weren't fantastic, but when I was raising money the first time, I was just looking for any money that was willing to back us. And I think what I learned is that you really have to pick your partners for specific traits that you need or to fill gaps that you have. So I love the founder journey. I love how hard the earliest stages are. And I think I understand that emotional journey as well as the building process of it. And so I decided to focus on pre-seed and seed because to me, it's the most exciting. It's the riskiest part. It's the part that, it takes the most hands on deck where I can hopefully add a lot of value as an investor. And it is the stage that I wish I had had a little more guidance for my own journey.
Perfect. And Elizabeth, I'll ask you the same question because it's the same journey almost, right? And yeah, I'm interested in kind of the migration, like what got you into this space, and what do you love about it?
Well, that basically resonates. I think a slightly different angle is that, I was not looking to get into VC per se. In fact, I was, after I sold my company in 2014, I spent a lot of time trying to figure out what is the next problem that I want to solve? What is the next business I want to build to solve a problem for the next 30 years of my life? And I was looking at all kinds of things, everything from, VR to Bitcoin to drones or whatever. And I realized that actually the problem that I'm very passionate about was like sitting right in front of me. I had a lot of struggles with my own fundraise and knew so many other founders I had been mentoring or backing who were also struggling with that. And I realized, I believe that entrepreneurs can come from anywhere and can look like anyone. But when you look at resources, funding, networks, education, or knowledge, those are not distributed equally globally. And so that was a problem that we are trying to solve with Hustle Fund, I think at a broader scope. And our first crack at that is with our VC fund.
Very cool. I'm actually a failed journalist. So I didn't even study economics or anything. I didn't even know what VC was until I sort of fell into this world. But what's interesting is we kind of, and maybe I'll direct this to Elizabeth, is like when we built Ascension, we built it like a startup. Like we thought about all of the different aspects that a startup needs to get to scale. For us is like you raise your first fund and how do you build a bigger fund, and your customers are essentially the startups. So how do you keep them engaged and resonate? Like I'd be interested, from you, Elizabeth, like do you have the same mentality? Because obviously you built Hustle Fund from the ground up, and the way you think about obviously the way that your customers are your startups. So it'd be interesting to hear your viewpoint on that.
Yeah, 100%, actually. I mean, I think when you think about startups and the problems that all startups have, regardless of what you're building, it's a couple of things. One, you need capital. And so we have to, go and raise our fund. And that's a journey in itself when you have no brand. And number two, you have to build your own customer acquisition funnel. So in fact, actually, our customers are startups whom we may back. And, we think about our top of funnel, like how do we get people to even know about us? And then what is the user experience as you go along, like interacting with either Hustle Fund content or our events or whatever, and all the way through the interview process of applying and then getting the check. Or on the flip side, and the more common case, like what is the user experience when you don't get the check? These are the kinds of things that we think a lot about, just like any other, B2B company.
Yeah, it's interesting. I think a lot of people assume that like investors, and maybe it's like just a generalist view, but I think investors, like they think about their LPs as their customers. And I think more and more actually, I'm starting to see that VCs and investors understand that actually ultimately it is the startups that are their customers, and that's only a good thing for the ecosystem, right? So I'll start with the macro stuff, and Andrea, maybe I'll start with you here. Sure. Thinking about the pre-seed landscape, because that's our topic of discussion, pre-seed being first check of investment. So how have you seen that evolve over the last I guess 4 or 5 years in the US? Obviously you've been at, I think 3 different funds on that journey to where you are at Basecamp now. So like what are the kind of trends or things that you've seen? I hate trends, but like what are the interesting things that you've seen in the pre-seed landscape over the last few years?
I mean, it's changed a lot. And I think first and foremost, what's changed is the check size, right? So when I was investing at Expa in 2016, check sizes for pre-seed were anywhere between 250 to 500K for roughly 20% of the company. And now that is not the case. That's not a deal one would get, at least in the United States. So now I'm seeing round sizes be closer to 750 to $1 million or even larger. Whereas pre-seed used to be the stage where, there were no customers yet. There may or may not be any products launched yet. I'm seeing that actually be more at the seed stage. So pre-seed stage is, if you can believe it, probably even earlier than that, right as someone is about to leave their job or has just left their job last week and is ready to start something. And based on their background alone, they're getting interest from investors. So I'm still a little bit old school in that I still look for certain indications, a little bit of product built at the pre-seed. But I would say what has changed is you really don't have to have too much built, and the size has changed a lot. I also think because we've seen a lot of exits and IPOs in the last 2 years or so in tech, there are a lot more angel operators, meaning that there are investors who are writing 25 to 50K checks individually by themselves. So pre-seed rounds, I'm seeing done a lot more by just cohorts of angel operators.
Cool. Yeah, Elizabeth, you did a great tweet yesterday. I didn't want to get into it like straight now because I wanted to dig into it a little bit deeper. But I guess it's relevant, right? When we're talking about like how the investment landscape has changed for founders. So like, talk to me about what you're seeing in terms of the way that founders are starting to raise funding, and how narrative is so important to building momentum in that early stage. And yeah, talk us through that.
I think just even taking a step back, like from an investor's shoes, I think if you put yourself in investor's shoes and you kind of think about, I don't know if it's game theory exactly, but if you think about the motivations, it is always better to wait as an investor if you know that you can get into a company at the same terms, right? Like, just think about it. Like, it's always better if you can get at the same terms 6 months from now, but have more information. Like that, it is much better for an investor to wait. And so I think with that perspective, then what founders need to do, and this is what we very much coach all of our founders at Hustle Fund to do, is like, you have to then create urgency. And the way you do that is by getting a lot of investors at the table all at the same time. It is not helpful to go to one investor, talk with them, and then, a month later, go to another investor. You need them all to feel like this opportunity may not be available tomorrow. And so then as such, how do you create urgency to kind of get the ball moving? Because it's such a chicken and egg problem. And one way is, okay, maybe you can split up this larger raise into a smaller one. And I'll kind of pause there, but that's like the general strategy that I think was not intuitive to me when I was a founder. Like, I had no idea, but this is what really gets around going. And then once you can get the smaller tranche filled, then you can start building, momentum for the larger raise.
Yeah, well, actually, you're right. Let's dig into that a bit later when we get to the founder stuff, because there's some really interesting insights, I think, gained from both of you around just that, like the investor landscape. And maybe I'll dig into it as GPs at funds, where these pre-seed rounds we're seeing, and especially in Europe, and I know it's been the case for the US because we're always a couple of years behind. Maybe we're catching up a bit now in this environment. Anyway, we see that like with brands like in Europe, in the case, you got Sequoia and Excel and Index are coming earlier and earlier now. And as pre-seed investors, you have to validate your position in funding rounds, whether they're hot deals or not. There's allocations that you need, and you need to think through like how your value add is going to get you in there. So maybe you could talk to me about what value add actually is for Basecamp and for Hustle Fund, and like what differentiates you from a super angel or a VC with a brand, or kind of other aspects there, and why that's important for investors to think through.
Elizabeth, you want to go first? Or?
Yeah, go.
Okay. So I think, actually it's funny because I think VCs need to think about the landscape of differentiation as well, just like startups. But funny enough, I think many VCs don't. And money is fundamentally a commodity. Like, it literally is a commodity. My money is as good as anybody else's money. So then the question is like, where do you play? And I think for us, like, we actually, going back to this point of, doing our own customer discovery and customer development, like, we have segmented out, like for the startups that we back, we actually have a customer persona title for different folks, and 80% of our customers are, what we call ambitious Allens. Like, they are founders who are founding a company generally for the first time, have not yet necessarily proven themselves, et cetera, in success in that. And that demographic, I think, is a demographic that the Sequoias and all don't go after. Those go after what we call the serial Sallys a little bit more. So, and then I think within that, compared to other operator angels or whatnot, like as a fund, we offer more scaled programs. So for example, we offer something called Redwood School, which is very focused on tactical customer acquisition. So we are not quite an accelerator. We don't charge for it in any way. It's just part of being in the Hustle Fund family. and you can get access through Redwood School to get tactical advice, one-on-one help with our set of mentors who are very focused on lead gen, outbound sales, and things like that.
Do you think that your speed of execution in doing deals gives you an outlier as well? Like, you have the infrastructure built and you can make those decisions in 48 hours, right? That gives you prime ability to get in things before other people hear about it.
That definitely helps a lot. And we built out actually our own tech stack to allow us to kind of move quickly like that. And I think in this environment, and I don't know if this environment holds, but in this environment, it's definitely more advantageous to be faster than slower.
And then for Andrea, obviously Basecamp is a well-known brand, and for value add, can you talk through like what you kind of pitch to founders when you want to get into deals, and what infrastructure you built in the back end to be able to support those founders as they go on their journey?
So I'm going to be blunt and tell you that even I these days wonder how any of our money is different from the other. Just like Elizabeth said, I mean, the money we're investing is a commodity. I'm not sure that my money is that much different from anyone else's around the table. But what I try and explain to the founders that I work with is, you're working with me, and Basecamp is kind of you to say that we're well known. We're still, new. We're about a year and a half old. And one of the things I remind the founders I work with is my success as a GP and, the ability to raise a second fund entirely depends on my companies hitting it out of the park, which means that there is nothing that we won't do to help you be successful. And I know that sounds like something I think most partners would say, but in comparison to some of the larger, name brand firms, you're sort of a drop in the bucket compared to a smaller fund like ours, where our whole world is to make sure that you're successful. So while we don't lead rounds, while we don't, we write smaller checks, we like to say that we under promise and over deliver. So some of the things that we do on a company level or a fund level is we give you access to our portfolio services team. And that comes through Alumni Ventures, which is our fund of funds. So Alumni Ventures has 17 funds associated with different universities around the US. Alumni of those universities are LPs in a fund that get to invest in other founders that have gone through the school. And so we have a really interesting distribution model and base of potential customers that we can introduce you to. So that's kind of an unfair advantage that we have. I myself have a background in enterprise sales and go-to-market strategy. So that's where I like to dive deep and jump in and help my teams. And then really no ask is too small. I think I was telling you earlier about how I even had one portfolio company ask if I could help be a booth girl at one of their restaurant tech conferences. This was obviously pre-pandemic. And I dressed up in a costume and I was happy to be their booth girl. I mean, that's the kind of high touch experience that smaller micro funds can offer that I think doesn't always happen at the larger funds when they have so many different companies and interests to support.
It's interesting. I've done some weird stuff for portfolio companies as well, which I won't get into. Not like too weird, but like some weird stuff. Because one of the issues I found, and like be blunt and brutal about it, is like you obviously when you're investing your first fund, and if you're a high volume investor, like I think our first fund we did something like 30 deals, which in today's day and age actually is not that many for a pre-seed fund. Obviously you can spend a lot more time with those founders as you're a smaller team and it's your first fund and you have more time capacity. Obviously then you go into your second fund and your third fund and you become possibly more well known, and the founders want more access to you, but actually access to you is a lot harder. So how do you think through like access to you? You're the one in your first fund selling yourselves and obviously the infrastructure you've built as well, but scaling that and still being as hands-on as you want to be over time.
I'll just quickly say it's a problem I haven't solved yet. And we talk about it a lot. Like how do we scale me or my partner Matt, for example? And there is going to be a breaking point, right? Where you can't help everybody. So one of the areas that I particularly like to help out quite a lot on is the follow-on financings. I think because I'm in a position of being a non-leading check, I'm non-threatening to a lot of the other funds. So I've done, I think, a decent job of getting to know everyone in the ecosystem, who I really respect, how they work with companies. I can see from a somewhat unbiased perspective, like who shows up and who really adds value as a lead investor in Series A's and B's and C's. So part of the way I like to say long-term, I'm helping our companies is I'm guiding you in the right direction, hopefully to people that I trust. I've seen how they work with later stage companies, and I know I'm putting you in good hands. And I set expectations that once you've passed Series A, or Series B, I might not be the best person to advise on go-to-market anymore or sales strategy, but I'm introducing you and helping you set up your Series A and B rounds with people who I have vetted and really respect.
Cool. So I've been reminded we have 15 minutes left, and I'd like to get some questions from the audience in for at least the last 5 minutes. So let's move on to the founder stuff, and maybe to you, Dunk Hippo, if we follow on from what we were talking about earlier, which is I think from founders' perspective would be interesting is one, understanding like what convertible loan notes and safe notes are and how a founder can raise using those, and how an investor should think about investing via them. Again, going back to your tweet yesterday, but what are you seeing founders do with convertibles and safe notes now?
Yeah, so I love how the safe has actually become really popular. So just for some quick context, the safe is essentially this templated document. It was written by Y Combinator, and the document essentially says, hey, these are the terms. When you raise an equity round, this money that is being invested will be converted per what we agree upon on this safe into that round into equity. So it's like a placeholder for equity, which makes it really easy then for founders to continuously raise. Like there's no start and stop time, unlike in an equity round. There's no minimum that you have to raise. And also it means that you don't have to spend money on your lawyers, because it's all templated. So I think that's number one. And number two, what that has allowed things to evolve in the ecosystem is like you no longer then have to find a lead for an equity round, et cetera. You can do kind of interesting things where you can say, hey, I'm only raising 200K right now. It's at these special terms. We're just going to sign on a safe. If you can move quickly, then let's sign and wire now. And we're raising actually a much larger round, like $1 million or $1.5 million. And so if you come in now on these special terms, then the valuation will be preferential to you on this safe. And once we hit that, we're actually going to be raising the valuation cap. And so you can create urgency that way by creating these smaller tranches. Even though you're raising $1 million or $1.5 million, you can create these smaller tranches with special terms to create urgency with investors and to really get the ball moving on your raise.
It's interesting. In the UK, we don't use safe notes because a lot of investors rely on something called like SEIS and EIS, which you may or may know is like a tax efficient way of doing it, and HMRC, very boring, but they put a limit on a 6-month long stop date, which limits obviously a lot of the way founders think about raising through notes, because the idea of notes is you kind of kick the can down the road and build momentum with the raise, and then you set your cap being like the valuation in which it will convert at, or a discount. We'd go into the technicalities. I think that there needs to be a shift, especially in Europe and the UK, to be able to have these kind of more accessible safe notes, because I think in the US it's going for a long time now, right? But it's definitely catalyzed a lot of funding rounds, which is good to see for startups. What's the risk for an investor in doing a safe note?
Oh, there are definitely some risks for investors. I think that because it's a placeholder for equity and not actually equity, in that regard, you don't have any power pretty much. So if you are investing in, let's say, an unscrupulous founder or something, you don't have a good relationship with that founder, you can definitely be taken for a ride. That is definitely the downside risk. However, I would argue that if you're a small angel investor and you're writing like a 10K check, you probably wouldn't have had any power anyway. So I think there's a question of even if you did have equity, like how much of a difference would it have made?
Yeah, you said something really interesting as well, right? Around using safe notes to be able to almost give different prices, being the cap, to different types of investors based on the value add that they bring. Because obviously we've been talking a lot about how capital is now a commodity. Like, maybe I won't dig into that too much, but like, how should a founder think about like the value an angel brings versus a value hustle fund brings? And then I'll go to you, Andrew, on another question. But just
Sure.
that little point I thought was quite interesting.
Yeah, I mean, I think conceptually, actually, I would love to move towards a world where every, let's call it safe, is structured differently. It's like literally a deal one-on-one with each person. Like, oh, I am willing to pay X at this valuation. I'm willing to accept this amount of money at this valuation from you. And that's based on how much you value that relationship. I think one of the challenges to actually getting there, because typically when I see caps changing, they generally only go up. I don't really see like somebody doing a deal at 3 and then somebody doing a deal at 7 and then doing a deal at 2. Like, you don't see that, partly because it's logistically challenging. But I think the other part of it is, most of the time, actually, people don't really know how valuable any of these investors are. So I think most people don't know what it's like to work with me prior to working. So I think that's what makes it challenging. But I think conceptually, you could imagine, let's say that you bring on either an angel or a corporation even, and you ink a distribution deal with them. That could be a really value add investor. Like, if you structure something like they're going to promote your product, they would be more valuable than somebody else who's just investing money. And so why does everyone typically have the same price in a round? Like, that just, to me, doesn't make any sense.
Yeah, super interesting. I'd love to dig into it more, but we only have 8 minutes left. Maybe another time. So Andrea, what's the best way a founder can get access to you when they're raising their round? Is it through your portfolio companies? Is it through co-investors you've invested with previously? Inbound? How do you think about that? Like, talk about how a founder can get access to you and get that first meeting.
I'm game for any version. I think I really prefer when someone I trust, whether it be another founder I've worked with, someone I just know even outside of work, or another investor says, I'm sending this to you because of this reason. I think you'll like it. And this is why I am, or maybe sometimes this is why I'm not doing it, but I think you'll like it. I love cold inbound emails, but I don't love them when they're not customized. I think as an investor, we get a lot of that inbound. And so it's pretty easy to tell when something's been copy or pasted. And, if you look me up on Twitter or LinkedIn or wherever, you can usually figure out where my areas of interest are or what kinds of companies I like to invest in. So if you're coming to me and saying, hey, I have this D2C consumer brand, I think it's up your alley, what I would usually write back is, well, why do you think it's up my alley? I actually don't invest in D2C. So just give me like make me feel like the prettiest girl at the ball, tell me a little bit about why you think I would be the right partner for you. But preferred route, I think, is through a warm intro, but not everyone has a warm intro. So I'm always game for an outbound or an inbound cold.
It's interesting. Like, if we focus on the email, Elizabeth, because obviously we're getting hundreds a week. Like, what's the best structure you've seen? We touched on it there with Andrea, but is there the hook at the beginning in that initial paragraph which gives context to that? And then, like, how can they build the hype in the rest of it to make you more interested? And should they attach a deck or not attach a deck, or give you a little taster?
I think less is more. So maybe the first sentence is to build rapport with, like, Andrea, like, hey, I really love that article you wrote, like, wherever, even something as small as that. And pretty much every VC has like produced something. So that's really easy, right? Like, I really like that tweet that you wrote, or that blog post you wrote, or that whatever, like, or that talk that you gave at that conference, right? And then just maybe a couple of bullets, I would love to get your thoughts on my company X. And then just a couple of bullets on, like, we are working with 3 enterprise customers in a pilot stage, or something that is like notable either about you as a team or about what you're doing or something. And then just, what is the best way to chat more? And I think that's it. I often see people's cold emails like selling too long for too many paragraphs, and that actually, I think, is a bit counterproductive to what people want to achieve. You just want to get the meeting. Yeah,
totally agree. And I think short is the best form, right? Because we all suffer in this day and age of having short attention spans anyway. So just being able to like pull out very quickly the key bits that you know ever resonate with you or not. I always like it when a company adds like a third party link to something that talks about them, whether it's like a press article about something, or because then obviously I can in my own time delve into that without having to go back with questions about certain things. So I just find that that's been quite a good hook. The thing that's not been quite a good hook is LinkedIn. Like I don't think I've ever done an investment through someone that's cold inbound on LinkedIn, like frankly, and Twitter maybe like a couple of times I've engaged with founders that do a direct mail, but LinkedIn would be at the bottom. So email, I still think, is the best form of getting there if you don't have that warm intro. That's just my opinion on that. So we've got 5 minutes. I am going to go to some audience questions. I actually did a couple of things on Twitter and LinkedIn because I was just slating them. I did stuff on it anyway, asking people to give some questions. Maybe I'll go for the first one from Rockman Law. And I'll pose this one to Andrea. Are soft commits from investors meaningful? How do you think about them as a founder? How should you think about them?
A soft commit from me is meaningful, and I believe Elizabeth too. But a soft commit is something that you can get out of if in the diligence process something goes wrong or if things take too long. In fact, there's only in my entire history as an investor, there's one deal I had to walk away from after soft committing for a variety of reasons, and it still haunts me. So it depends on who you're working with and who you're approaching. I think a lot of people unfortunately say, oh, we're soft committed until you find a lead. And I wouldn't say that's my favorite thing in this industry. I think you really kind of need to, somehow get in writing with that potential investor. Like, okay, so if we get a lead check or we get, terms set by somebody else, you are in. But I think founders need to realize that a soft commit is just that. It is non-binding. It can be walked away from. So be a little bit more conservative when you count the money in the bank before it's arrived with a soft commit.
Yeah, one of the dangers I also see sometimes is that, we are a relatively small community, the VC community, and I've had founders say, VC X has committed to the round, and I'm likely to know who that VC is, so I'll go back to them and say, oh, you committed to this round, and they say, oh yeah, we had like one call 3 weeks ago, and we haven't even kind of advanced that at all, and that's a negative indicator. It's like a red flag instantly because they just don't understand the process, and it's difficult, but I see it a lot. I don't know if you've got any additional kind of advice on top of that, Elizabeth, just kind of thinking through soft commits.
I would just really actually push on that. Like you need to understand, I think, as an entrepreneur, like why is somebody soft committing as opposed to actually signing something today? Such as an example that Andrea gave, like if somebody says, oh, I need a lead, you should really dig into that. Is it that they want terms to be set, or is it that they want somebody to put in half of the round, or what is it, or they want somebody to sit on your board? Like, what is it more specifically that they're looking for in a lead in order for them to sign? Because you really want to address those concerns and get people to a signature as quickly as possible.
Yeah, and just to quickly add on that, I think some investors are waiting for signal from another brand name fund to say, oh, now I'm really convicted, I'll commit. And I really despise that sort of approach. And I know Elizabeth and I both operate with, we can commit if there's no lead involved. But I think she's absolutely right. You have to dig in on what is preventing you? What is your goal? What do you need before you do a hard commit? Because soft commits can be wiggled out of, and I don't love that.
Right, last question, and it'll be a quick one. I'm going to condense Sachin's question to maybe one point, which is how do you see the development of micro VC funds in Europe? But let me ask you both generally, what do you think of micro VCs and solo GPs? Like, what do you think the landscape will look like over the next 2 years for that type of investment vehicle? Elizabeth, maybe start with you.
I'm very bullish on it. You certainly see the rise here in the US. I think that's going to happen everywhere, including in Europe. And I think that's a good thing because A, you have investors who have been there. B, generally they can commit quicker because there are fewer decision makers. It's just them. And so I think the long and the short of it is like, I do really hope that more of those come to Europe.
Same response on my side. I think micro VCs are going to, proliferate in Europe as they have in the US. I think in the last 2 years, we've seen like, a triple number of micro VC funds started, and they're great to work with and they're amazing. And I think you're going to see a lot more of that in Europe. What I'm interested in is 5-6 years from now, will there be fund 3 or 4 for those micro funds, or will they turn into something else?
Perfect. So it looks like our time is out. You're both awesome, by the way, and love what you're doing over in the US. And I know that you're both looking at European businesses as well. So if there's any European founders out there, they're not limited to just US companies. But thank you both for joining at what is probably about 9:30 a.m. in the morning for you both. So appreciate you coming on, and lovely to talk to you, and have a good rest of your day. And thank you for everyone watching.